Hello and welcome to Swarajya Conversations. We have as a guest on today's program Siddarth Pai, who's the founding partner of 314 Capital. He also writes on issues related to startups and entrepreneurs, especially in light of taxation for various publications. So it's been about 7-8 days, probably a little more than that, since the budget was announced. So it's a good time to catch up with you, especially in terms of the vision of Startup India and what measures were taken in the budget in terms of what is proposed and how it pans out.
Sure.
Let's start with, of course, probably one of the more contested ideas, the ESOPs, which is employee stock option plans. There was always a problem in terms of the double taxation that happens in terms of ESOPs. Now that has been sort of not addressed. How do you see that? What's the problem there?
So ESOPs are one of the means of democratizing wealth amongst employees. It ensures that every employee, anyone contributing to the business, can actually become a shareholder and enjoy the benefits of being a shareholder as well. It started off in the 50s in the US, where in terms of succession planning, instead of actually giving it to their children or something, they actually want to bequeath their entire stake onto their employees based on certain criteria. So from the 56, if I'm not mistaken, it slowly started evolving, and now the ESOP frameworks around the world have actually been created. The way ESOP taxation works, just as context behind this, is it's actually taxed. So every employee is actually given options, and the options translate to X number of shares. Then once they get those options, these options vest, as in they actually get the right to actually exercise those options. Then at the point of exercise, where they can actually pay some money, get those options converted to shares, there's a tax that's paid, and that's going to be taxed as income from salary. And then later at the point of sale, there's once again there's some amount of tax that to be paid as a difference between the sale price as well as the fair market value. Now at the point of exercise of the options, any gains that you have are actually notional gains,
right?
Because the way they tax it is different between the fair market value, which because of the Indian income tax law under Section 17 Income Tax Act Rule 3,
right,
as well as Section 56(2)(7)(b) and 56(2)(10), because income from other sources. The amount that actually comes in, the fair market value is the price of the latest round of funding of the company.
Right.
Now, why on earth should an employee pay the price that an investor is actually paying? And that to pay tax on those notional gains. Now, no employee, because you're a startup, you're an unlisted entity. There's no open share market, stock market for you to actually go sell your shares. And because you get common equity, whereas all the other investors, etc., get a convertible instrument. They get preferred stock, preference shares, compulsory convertible debentures, etc. There's a discount that's always attributed to the equity shares. So no employee can actually enjoy the fair market value at which he's actually paying tax.
Right.
And that economic outflow of tax on notional gains happens immediately. And because they're unlisted, it's only at the point of exit can they actually sell, which is like 3, 4, 5 years down the line. So you actually run the math. A large number of employees have to take loans from banks, from financial institutions, from their own companies or friends and family in order to become a shareholder. That is a sorry state of affairs for any entrepreneurial ecosystem or startup ecosystem in the entire world. And that is a fundamental problem, unfortunately, that the government in this budget did not solve. The government solved, there's a problem of timing, as well as the problem of cash flows and the problem of taxation. The problem of taxation is the highest part because nowhere else in the world did they actually tax ESOPs on the basis of the price of the latest round of funding. It's only India who does that.
That too, we are talking about hard liquidity, right? Like when they have to pay at the time of exercise.
Yeah. And that is immediate money that has to go out. And no employee actually has that money because ESOPs actually make up 30 to 40% of your paycheck.
Right.
And you have to pay that entire thing out in cash at that point in time, and there's no certainty of you actually getting those gains out. A large number, the mortality rate in startups is quite high. Everyone already knows this. And as you've seen, none of our startups have actually gone and listed. The largest exit to happen so far has actually been Flipkart. And because of this, there are companies like Swiggy, like Swiggy, like Paytm, like even Flipkart at one point in time, who actually started engineering share buybacks only for their employees in order to get them liquidity.
Right.
Because the employees were stuck for 3 to 4 years. And India's ESOP taxation regime was created more for listed market entities. So created for your Infosys, your Wipros, your TCSs, etc. It was never created for Indian startups. The reason behind that is quite simple. Because if I'm on the stock market, I can immediately see, let's say my exercise price is $45. The stock price is 50. I'll immediately exercise it, get my shares, sell my shares on the market at 50 rupees, get that 50 rupees in hard cash, and I can pay whatever tax I have to.
Right.
Whereas for a startup employee, the moment I exercise it, I get shares and I immediately pay tax. I don't get any cash.
Yes.
And if you have to pay taxes out of your own funds, it becomes a liquidity issue for them. And the liquidity issue hasn't been sorted. Even deferring the tax to 4-5 years down the line, hypothetically in this scenario, let's say, for example, the fair market value of the share is 100 rupees. The exercise price is 10 bucks. 100 minus 10, 90. You have to pay tax on that as per your normal slab
Right.
rates. 3, and under this new regime, you can defer that to 5 years or to the point at which you leave or to the point at which you sell your shares.
Right.
Let's say hypothetically in 3 years, the company actually tanks. The company doesn't do well and you can ultimately only realize, let's say, 5 rupees.
Right.
You still pay tax on that 90 rupees.
Right.
That problem hasn't been solved. So imagine that as an employee, you're not making any money on a transaction. You paid so much money in tax and you actually made a loss after that. How is an employee supposed to feel?
Absolutely.
And that is the core issue that the government actually hasn't sorted. A number of bodies, such as the Indian Venture Capital Association, iSpirit, which is a startup think tank, have approached the government. They've approached DPIIT. They've approached CBDT. There is some hope still that's out there, but most of the employees and most of the entrepreneurs are extremely disheartened at what's happened so far.
Right. The other challenge is, say, if the stocks of the company tank after a while, you still have to pay the tax on that.
You still pay that tax. And imagine the insult that the employee actually feels for no fault of his own. The company couldn't raise capital, and a number of Indian startups actually failed because they're unable to raise capital. Right. The company couldn't do much for no fault of his own. He still has to pay that particular tax out.
Right.
And that's genuinely going to hurt them.
Right.
And because of that, now ESOPs becomes a way almost in the US, Singapore and China, etc. People don't mind taking up to 60% of their paycheck in terms of ESOPs.
Right.
Because the taxation regimes, in case a company tanks, they don't have to pay anything. It's just like salary foregone. The company does well, then they don't mind paying taxes out of the gains they actually make.
Right. Right.
But taxing them on notional gains is actually quite frankly absurd.
Right. Now, great emphasis has been placed on sort of helping startups grow. I think the finance minister also referred to them as engines of growth, and Modi has also talked about how probably $1 billion of $1 trillion economy, 1 trillion should come from startups is what his aspiration is. And in a lot of areas, it seems to be working fine, but somehow in taxation, it seems to be struggling a lot. Like in 2019, I think Indian startups raised about $14.5
billion
in this thing, and also the valuation is at $150 billion, right?
And more than 90% of the money came from foreign sources.
Right. So what is preventing this progress on taxation? Because this seems to be the thing that's pulling them down, isn't it?
Even our honorable prime minister articulated that as a $5 trillion economy, 20% of that has to mandatorily come from new age businesses and startups, because we are the industrial age, the computer age, we're actually entering the innovation age, and innovation always happens at the edge. And from that edge, it actually bleeds and actually comes towards the mainstream itself. So Paytm was a fringe player 6 years ago. Now Paytm has become part of our everyday vocabulary. The same with Ola, same with Flipkart, the same with Licious, the same with all the companies you can possibly talk of, right? So startups these startups are actually driving innovation across the entire world. So Startup India was the government's way, and especially the Prime Minister's pet project in terms of actually bringing startups to the forefront. Many government departments such as DPIIT, the Ministry of Corporate Affairs, then you have the regulators such as SEBI, RBI, the department that actually does government procurement as well, so the government e-marketplace. All of them have actually opened up to startups to a very, very large extent. They've reduced the threshold in terms of positive net worth, so much of profitability before the government actually procures from you. They made it easier for startups to raise capital from foreign sources as well, which RBI has done. SEBI created the framework for the alternative investment funds, the AIFs, to allow venture capital funds to actually grow as an industry in India.
Right.
But the single point of failure of Startup India, if you ask anyone, has actually been the tax department.
Right.
Even whatever was announced, like even on the ramparts of the Red Fort, when Prime Minister Modi spoke about Startup India and said they will have a tax holiday and a whole bunch of stuff, when it actually became law, when Arun Jaitley made the speech, they started putting needless caveats. If you're not considered a startup under the income tax department unless you're incorporated after April 1st, 2016.
Right.
So imagine that everyone in January, when the Prime Minister announced, said, okay, I don't mind actually, people on the fence who want to start their entrepreneurial journey started it, and they were actually denied the tax benefits.
Right.
Out of 50,000 startups operating in India, 27,000 of them are registered under Startup India with DPIIT.
Right.
Out of that, the estimates are only between 250 to 300 of them actually got any tax benefits, because the tax department says you have to register. You register with the tax department with something called the IMB, the Interministerial Board. It's a group of bureaucrats and ministers who sit together and say, is this company innovative or not?
Yeah.
And the feedback I've actually gotten from a number of people is like, there was a person who's actually was the first person to write code for Google Maps. Google Maps is used by more than 1 billion people. His second startup, that when he tried registering with the IMB, got denied because he wasn't innovative. Imagine calling the guy who created Google Maps not being innovative, because some of the ways the IMB actually looks at this, it says that, okay, here's your business model. There are 4 other companies in the world, one of them being Google, the second one being Facebook, and 2 other ones who are in the same space as you. How are you innovative? Google was the 7th search engine to actually come up, and now it's become one of the largest companies in the entire world. Innovation doesn't mean being first. Innovation means actually doing it better than anyone else. And the way innovation can actually get fostered is have a taxation regime that actually incentivizes risk. Our tax regime, unfortunately, look at the benefits given to startups. The tax holiday, there's not much that actually happened over there. In terms of carry forward or losses, there's a change in shareholding, Section 79. It's only for startups incorporated after April 1st, 2016. So if I want to do M&A and the carry forward losses startup, I want to absorb that, I knock that off against my profits or carry forward those losses. I can't. So that M&A in the rest of the world, when they acquire startups, they can actually carry forward those losses. In India, unfortunately, you can't. You have something called Section 54 GB, which says that if you sell a residential house property and invest those gains into the shares of a startup, then those gains are exempt. Unfortunately, list of conditions over there, you can't use that money to buy computers, you can't use that money to buy software. You can only invest into equity shares. Now, if I'm an entrepreneur, if I'm an investor and I manage to sell something, if I go into a technology space, I can't even avail of that benefit. And the bulk of our startups in this day and age use technology in some way or form. They have to get the only hard assets you look at the balance sheet of any startup is actually been your computers, right? And if you can't invest in that, what is the point of that particular exemption? Then you have something called 54E. Like this, there are numerous examples of these conditions being put in, which all suffer from what I call hamasha. There's one little Achilles heel in the entire notification that actually disrupts and destroys the good that a notification is supposed to offer you. And angel tax in India, which hasn't gone away, it's been reduced to a large extent, is actually the prime example of that. It went through 4 different circulars. It went through everyone fighting it. There were petitions to the government, petitions to all the ministers, petitions even to opposition parties for help towards the end. To 4 different iterations, we've reached a stage now where if you want to get exemption from angel tax, which I'll speak about a little later, you can't invest in any shares and securities. So your treasury operations can't be done through money market mutual funds regulated by SEBI. You can't acquire another company because you can't issue them stock and actually get stock in that regard. You can't give loans and advances. So technically, if I give a loan to my employee, in order for him to actually exercise his ESOPs and pay the tax, I no longer can. My advances to vendors, my advances to anyone are now no longer allowed. What is the reason behind that? Why would you have such a glass ceiling on entrepreneurship in the country? And all this is stemming only from one department in the government, which is the tax department. And unless we actually rectify our tax policies, and we're already seeing this happen, a number of people, there are actually headhunters literally from Singapore and other countries, Singapore, UK, etc. And scout funds. They come to India and say, okay, fine, you're an innovative company. That's great. Why don't you actually re-domicile to either the UK or Singapore? We'll offer you AWS credits. We'll offer you $100,000 in seed funding. We'll make sure that you don't have to pay rent for like 18 months. They give you a whole host of benefits. And our best companies are actually going there. And they say, okay, fine, set up a headquarters in Singapore, have a subsidiary in India, business will continue as usual. And if we don't actually correct our tax policies, we'll end up becoming a country of subsidiaries. The Britain was supposed to be a country of shopkeepers. India will become a country of subsidiaries. Is that really the future we actually want to leave? Is that the legacy that this government wants to leave because of the tax department?
Obviously, there's the expectation of a change in the ESOP taxation regime. But now, talking about long-term capital gains, that was also supposed to be in the offing. At least the expectation was there. But now, according to recent reports, I think the finance ministry is saying that it's going to take a look at it maybe a year later. What is your assessment of that?
It's been a lost opportunity, I'll be very honest with you. The least the government could have actually done was to roll back the super rich surcharge at 25% and 37% for unlisted securities. They rolled it back, I think, in September after announcing in July for listed securities, but they haven't rolled it back for unlisted. Now, unlisted securities by definition, and securities of startup for that matter, they're illiquid. They're not on any market. There's no ready market for that whatsoever. They're extremely risky. These are companies with an operating track record of a couple of 18 months, 24 months. It's always been in the red. They haven't seen a year of black at all. None of them have been profitable. They aren't profitable because it's the business model itself. They want to go for growth. Once they stabilize, once they've launched a significant beachhead, then they'll actually start moving towards the path to profitability. They're illiquid and they're uncertain. the mortality rate for startups is far higher than the mortality rates for unlisted startups. So while the rest of the world, if you look at the principles of taxation, in case it's for the public good, and if it is risky and actually goes into primary investments that actually create jobs, it creates employment, you actually have a lower tax rate for that, right? That's actually common sense, because the purpose of taxation is to raise revenue for the government. It's also make sure that the public resources are sort of harnessed into more productive means. Right. That's why gold and all are taxed at high because they're unproductive, whereas securities are taxed at a lower rate because securities go into creating jobs, etc., etc. But in India, unfortunately, you have the super rich surcharge that applies, which actually driven up the long-term capital gains rate on startup securities to 28%, whereas the listed counterparts are actually at 11%. Right. 2.54 times the listed security rate is the rate that unlisted securities have to play. And if you look at the stock market, with all due respect to the stock market doesn't, there are very few primary injections of capital that actually happen. Right. Most of it is basically trading amongst, okay, I bought this share 3 years ago, I'm going to sell it now, someone is going to buy it, hold on to it, and then sell it later. Right. So the stock market price, while supposed to be reflective of the underlying economics of it, if the stock price goes up, the stock price goes down, the business is going to continue as usual, right? That's why a number of, even the ex-Prime Minister Manmohan Singh said that he doesn't actually stay up because of the stock market. Even Narayan Murthy and several entrepreneurs have said that, okay, our stock price is not reflective of our business, reflective of the investor's mood as to our business. We know our business well, so we'll actually continue doing that. They didn't have the super rich surcharge applied to that. Whereas for startups, which are actually creating jobs, all the money that goes in that goes into them has actually been primary injections of capital. And when the exit actually happens, then you obviously need to have a post-exit gains that actually make sense, given the illiquidity, the uncertainty, the risk factors associated with that. Right. Unfortunately, India is the only country that actually seems to say you have to hold on to unlisted securities for twice the amount of time, for 24 months as opposed to 12 months, and you have to pay a higher tax rate. Now, the stock market in India has been compounding at about 15% since year 1990. Right. This everyone knows, and the gains were this one, not taxed for a long period of time. As an Indian fund manager, and as I speak to any of our peers as well, we keep talking about this. It is impossibly hard to sell the Indian startup story in India because of these factors. Every single Indian investor or LP you go to, after you hear your pitch, they say, why should I invest in you? And they only go back to tax, saying that I can invest in a listed or mutual fund or listed market, hold on to it for 1 year, I only pay 11%. With you guys, I'm stuck for 4 to 5 years, I have to pay 28%. Something goes wrong, I can't even take benefit of all the expenses that actually accrue in that particular fund, whereas you can for a mutual fund. Why should I actually invest into you? True. Even there are large marquee funds, international funds, when they don't have a specific India fund, they have an allocation to India and Southeast Asia, which usually manages out of either Mauritius or Singapore. And even when I spoke to the Indian partners as well, they were saying that it's become harder to actually convince them to invest more money into India, because those partners, it works in partnership, right? It works in majority. Yes. The Southeast Asian partners are saying that, look at Singapore, they have no capital gains rate. Look at Indonesia, they've actually reduced it. Look at Thailand, they've actually reduced it. Look at Philippines, it's lesser than India. So on a post-tax basis, the Indian startup story is actually getting hit because of that. We raised $14.5 billion last year. Yes. If we had better tax policy, we could actually raise a much higher amount. The biggest burden that the Indian startup ecosystem faces as of now is the lack of exits. Right. If you have an exit that's close to a third of the total gains you actually make, most people are going to say, why should I actually come in here? They rather hold on to it for longer and hope for something better. Right. So the long-term capital gains, well, a lot of people say there are modern financial theories that tax is not such an important part because it affects everyone. If it affects everyone in that ecosystem. The moment you broaden that and you start comparing different tax rates, that hypothesis actually breaks, right? Well, India is good, India is growing, India needs better taxation policy so that the startups can actually do better. This is actually one of the reasons why people actually just don't mind actually sitting in Singapore. They are sitting in Singapore, invest here, zero capital gains over there. They pay that 20% tax or something they have to pay over here, and then they all move on with life. Right. That's the problem. Yeah. So this is something the entire industry has been crying itself hoarse for a long period of time. And every time we meet government, we meet the tax officials, they come back and saying, how do we make sure no fraud happens? So this, the simplest answer is we'll actually demat our securities. We'll have a depository participant, the same way it gives you complete traceability. The recent income tax forms have also stated that you have to declare all the shares you hold in unlisted companies. That lack of transparency that used to exist no longer exists. So you're making it more onerous on them. More onerous in terms of compliance, more onerous in terms of reporting, but you don't actually give them the commensurate benefits of transparency. What is the point? We actually run the risk of actually killing the golden goose. Absolutely. And that would be a tragedy for the entire nation, especially starting off the 2020s. If these aren't actually remedied, it's gonna sour the mood for the remaining decade. It's supposed to be the decade of India, right? And Indian startups, right?
In fact, this don't kill, defer
Yeah.
approach, which was there for the LTCG,
Yeah.
was also seen in the case of angel tax,
Yeah.
right? Like you said, that it went through so many iterations, but it still is there.
It still is there.
And do you see any optimism on that front? What's the future with
It's
the
not.
angel tax?
So a number of people when they get invested, what we're seeing happen more of late is a number of entrepreneurs are saying, okay, if like friends and family are putting in money, I actually don't want your money.
Right.
They're just flat out rejecting it, saying that, listen, I don't want to go through this. I want to be able to maintain flexibility as I grow as a startup. Now, if you actually think about it, if you look at the angel tax regulation, they say you're a startup for 10 years. Hypothetically, under the DPIT definition, startup for as long as you've been there, 10 years, and less than 100 crore revenue. And revenue for a number of these companies, it'll keep growing, but profits not going to come completely fine. So for 10 years, I can't invest, I can't do any M&A, I can't make any loans and advances, I can't pay an advance even to even pick up, let's say, a fixed asset.
Right.
If I want to pay, my rental deposit is actually illegal now. I can't even rent a building.
Right.
And that lasts for another 7 years after that. So for 17 years as a company, you can't do any of the normal stuff any of your peers can actually do.
Right.
What is the point of even going for that exemption? And what is angel tax? You actually look at it. It's not an angel tax, it's an Indian tax.
Yes.
It doesn't apply to foreign investors
Right.
or NRIs. It applies only to Indian investors. Does the tax department really believe that every single Indian in this country is a crook? That if they invest into a company that they have to be taxed? They're taxing capital as income.
Right.
That goes against the very principle of income tax, which is a tax on income, not on capital. The moment you start taxing investments, it's a thin end of the wedge. That's why people have been fighting. That's why Indian money coming into a startup ecosystem is less than 10% of the total money being raised.
Right.
So all the gains, and we've tried to explain this to them multiple times, all the gains that actually happen, instead of 100% of the money being reinvested back into the country and staying,
Right.
the tax department seems to be satisfied with 20 or 28% of the money remaining back as tax. And the rest of the money is going to go. Capital at the end of the day is cowardly. It looks at opportunities. If the opportunity in Southeast Asia, the opportunity in Africa, it becomes more tantalizing the opportunity here, and they'll actually lower the tax rates. On a post-tax basis, let's say, fine, India is growing, enough people here, why don't actually go there? Right? So we can't expect that these good times to actually last for a long period of time. So we have to capitalize upon what we have as of now, and then actually create the bulwark that we need so that more domestic capital comes in.
Right.
And we aren't completely reliant on foreign capital. No ecosystem as a whole can grow if it's completely reliant on external sources of funding, unless it actually has internal pools to actually support it.
Did the DDT going make you any more positive about the situation?
So as a startup investor, most startups don't actually have profits to actually pay their dividends out of. So dividends aren't a very large part of the return portfolio for a startup investor. When I spoke to my listed counterparts, some of the people in the listed space, etc., most of them are now scratching their head and saying that they've just taken so usually when they tax dividend, take it at the maximum marginal rate,
Right.
which in India now is 42.7% under the old regime. The new regime is this hodgepodge that people are still working out as of now. But imagine all your dividends actually taxed at that amount. Now, the promoters of these companies are usually the largest shareholders as well, right? Now, most of them, it's safe to assume they're going to be at the highest tax bracket.
Right.
All of them immediately going to start getting taxed at that particular high amount. So there's going to be some amount of restructuring we're going to notice in terms of setting up family offices, holding companies, etc., in order to reduce that particular part out. Another thing that's most probably going to happen is people are going to start, instead of giving dividends out, a number of companies will say, I'd rather not give the dividend out, I'd rather actually take that, issue bonus shares or something out of that, and then actually just buy those shares back later.
Yes.
You can actually look at dividends. Even in modern financial theory, dividends are supposed to be agnostic to dividends, provided the tax rate is actually the same.
Right.
Given the tax arbitrage that exists as of now, it's a problem. And even the last year as well, the government's been exhorting India Inc. to invest to start making more investments.
Right.
Into more plant and machinery, setting up new projects, etc. So one of the ways they did that is they actually slapped a 20% tax on buybacks during the last budget. And now they actually made dividends taxable in hands of shareholder at the maximum marginal rate. But what happens, at the end of the day, if you're a company, you only start giving dividends when you no longer have any attractive opportunities, right? If I'm in oil and gas, for example, I can't exactly go into education, I can't go into technology, unless you're Reliance. Reliance they managed to do something no one's ever seen in the rest of the world. But if you're any other kind of company, you can't diversify. It's not that easy for you to diversify because people invest in you for what you do, and you know what you do best. You can't just go into all these other things. So returning money back to shareholders is part and parcel of it. But taxing it at 42.7% is just completely absurd. We have one of the highest tax rates in the world, at amongst the lowest slabs of income. It's anything commensurate even to the US and all. The US has a tax rate equivalent. It used to have a higher tax rate, especially in places like California, but they
Right.
get tax credits for all taxes paid on the municipal level, on the state level, and they get those credits into a federal level as well. And that highest tax bracket only applies at a much higher amount than the amounts actually applicable to in India.
Right.
And they have a broad enough tax base to actually absorb that with enough exemptions built in, so that the effective tax rate is always lower.
Right.
This government seems to be removing all the exemptions and actually increasing the tax rate. You're supposed to remove exemptions and lower the tax rate.
Right.
They lowered it for corporates. They haven't done much for this one. They haven't done much for the ordinary individual.
Right. Now with the startup India vision in mind, I'd like to ask you. I know that entrepreneurs and startup guys have a thick skin, and they're able to sort of cope with all this. But what were the 3 things that you would recommend that would really sort of allow startups to take off in larger numbers?
So the 3 things you can actually do will primarily be in terms. Okay, I'll make it that combination. The first thing you have to do is actually reduce the long-term capital gains rate.
Right.
This has been the common chime of both investors as well as the entrepreneurs. Because an entrepreneur at the end of the day says, I want to do good, I want to actually grow this business.
Right.
Past a certain point, they're going to become agnostic, saying, okay, I have to be in India to grow this business. I can sit in Singapore, I can actually grow the business in India from Singapore.
Right.
And a number of people, because of adverse tax policies, are choosing the latter approach, which is unfortunate for the entire country. So that's going to be number 1. Just give us parity. Don't even give us a better regime, completely fine. Just give us parity with the listed guys. So that arbitrage that exists actually goes away.
Right.
That's number 1. Number 2, the compliance in this country is actually erupted to a very large extent. The compliance time has to be brought down. It's the same amount of information being given in different formats to various regulators.
Right.
So you give it to the MCA, you give it to ROC as part of MCA. You also have to give it to a tax department as part of your tax audit. You give it to the CBIC in terms of GST, or to give them all those particular details as well. There's your PF stuff, there's your professional tax, there's your ESI, there's so many different, your labor compliances. All these compliances are eating upon the mind of the entrepreneur. In fact, the joke, and the investor as well. In fact, the joke in the industry, the investing industry, is that every fund has a 2% investment team and a 4% compliance team. Because there's that much compliance that we're actually burdened under as of now. Like, ease of doing business is not just incorporating a company, which the government has done through the SPICE form, etc., or shutting down a company, which the company has done through the winding up rules as well as the IBC. Operating the company in between actually takes a maximum amount of time, and the paperwork involved over here has not gone down at all. There are some estimates that people actually spend 40 to 50 hours just doing their monthly compliances.
Right.
They have dedicated compliance people in their firm just to keep abreast of what the new laws are.
Right.
That has to reduce. Number 3, if you actually look at it from a startup perspective, it has to be in terms of ease of access to credit and ease of access to capital.
Right.
A large amount of our banking infrastructure and our banking ethos is based on asset-based lending. You look at the size of your balance sheet and say, okay, fine, if I'm giving you a 2 crore loan, you need to have assets worth at least 5 crores.
Right.
And as I said previously, all startups, they have a security deposit, they have some laptops, they have some code. That's it. And they have cash on their asset side. They don't have any fixed assets. They don't go buy buildings.
Right.
They don't go build large campuses. They don't have plant and machinery. They're all technology based. They don't even have server farms because AWS, Google Cloud, Geo Cloud, etc. So when that happens, but what they have is cash flows. They have large amounts of money coming in and coming out. So unless we move from asset-based financing to cash flow-based financing, we're not going to see the sea of change, because every single entrepreneur in this country, lack of access of credit is actually hampering them to a large extent. They keep raising rounds and rounds of equity financing for working capital purposes. And that working capital is required for 1-2 months max, just until they actually get their receivables from everyone. So now the government is, thankfully there are volunteers at iSprit, and the government is listening to in terms of discounting your GST bill based on the creditworthiness of the person you sold it to.
Right.
So I'm an MSME, I sold it to, let's say, a Reliance or a Marico or an ITC. I know for a fact that they are going to pay me, right? So I can actually discount my bills based on that. Then there's app-based invoice financing, which got announced in the budget as well. Baby steps are being made over there. But unless the banking infrastructure, which is already under tremendous stress, opens it up, even if they make available 4-5 crores initially, they slowly build up confidence over time.
Right.
And they should also understand that the investors in these companies, along with the investor being to back this company up for a longer period of time, the risk of a default is actually significantly lower.
Right.
So there are different models of banking that we have to do. So as we aligning the tax rate, reducing compliance, and easing the access to credit and capital.
Great. Thank you for all the points and insights. It was nice talking to you.
Nice talking to you as well.
So that's all we've got for you today on Swarajya Conversations. Catch you in another one.